Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and today we have Black Knight's updated report for foreclosure and default data. So we'll go into that report, and then after that report, I'm going to go into the consumer health as far as how much money can people save, credit card debt, auto loan debt, bankruptcies, and evictions. And if you guys can remember, I'm not a financial advisor, even though my bio is as a realtor, loan officer, and instructor in real estate. And I have been someone that has been helping consumers, predominantly first-time home buyers, for the last 2 decades. For that skill, for that knowledge, please, you guys, like this video, subscribe if you haven't already, shoot me a comment below, and don't forget, you guys, super important, share this video. I would really appreciate it. Regardless, we'll jump into the Black Knight report right now. And as always, you guys, do not forget, in order to empower you, in order to help you formulate your own opinion, everything will be linked in my description below. Now, this says June 23rd right here, but it is not June 23rd. This is actually July's report, I can assure you that. But serious delinquency mortgages hit lowest level since 2006. Prepayments trended seasonally higher in June, despite elevated interest rates. Couple of the bullet points here. Inching up 2 basis points from May, the national delinquency rate continues to hover near recent record lows, with June's marking the 3rd lowest level on record. And that's not really a surprise, because right now, there's really no need for foreclosure so long as you purchase prior to the middle of 2022. After the middle of 2022, there's probably going to be a need for foreclosure. But right now, with massive equity, with super low interest rates, the ability to sell your house, there's just not a need for foreclosure. There's still so much equity. Second bullet point, the number of serious delinquencies dropped to 471,000, the lowest level since August of 2006, and 177,000 improvement from June 2022. And that is a remarkable improvement. But I do want to point out this. If you really pay attention here, look at this, guys. The lowest level since August of 2006. What happened in 2007 and in 2008? We had a horrible foreclosure crisis in the face of low serious delinquency, just like right now. So what am I trying to tell you guys, and what does that tell us? It tells me that things can change a snap of the fingers. If people stop making money, if people start losing their job, it's game over. And I don't care if they purchased prior to 2022. If they can't sell their houses because the housing market's crashing, then it won't matter if they have equity. And I believe we're going to see an overwhelming amount of short sales for anyone that purchased 2022 and on. Again, prior to 2022, as long as people didn't refinance into a higher rate, they're going to be able to sell and they're going to be able to cash out. But again, think about it. It's the lowest level since August of 2006, right before the great financial collapse. Early stage delinquencies increased by 19,000, while borrowers who've missed 2 payments ticked up by 1.7%. Foreclosure starts increased slightly to 27,000 for the month, just 1% above the preceding 12-month average, and still 38% below June 2019's pre-pandemic level. Foreclosure was started on 5.8% of serious delinquencies in June. That's up 5.1% in May, but still 3 points below the start rate in May 2019 before the onset of the pandemic. Again, this all makes sense considering the fact that we don't need foreclosures right now. Again, unless you purchased after 2022. The number of loans in active foreclosure shrunk another 5,000 in June and is still down 17% from March of 2020. Meanwhile, June's 6.9K foreclosure sales marked a 1.5% increase from May. So all of that essentially means that on paper, it looks like overall homeowners from a delinquency rate are doing pretty good. However, it's also telling us that certain things are increasing, which basically is also telling us this. If you are in serious delinquency, the odds of you getting out of serious delinquency is a challenge, and it is likely that you actually go into foreclosure. So now we're starting to see that back end start picking up. When we go over the numbers and percentages, we can see that the top, pretty much every single thing is actually up, except foreclosure pre-sale. That's down 2.5%, but total U.S. delinquency delinquency rate is actually up 0.55% month over month for a total of 3.12%. That is historically low. There is no denying that. That is a pretty low rate, but also there's no denying how quickly this can spiral out of control. There is no denying that. This can spiral out of control super quick. But total U.S. foreclosure pre-sale inventory is sitting at 0.42%. That is down month over month by 2.5%. Now, here's the big one, right? This is where people start losing their homes. Total foreclosure starts on 28,000 families in the month of June. That's up month over month, a whopping 10.3%. So things are getting a little bit worse for people that are in serious delinquencies. If you look at year over year, that is down 11%. Again, it should be down being that home values have went up so much. Now, when we go to total U.S. foreclosure sales, they sold up almost 7,000, but they sold in June 6,900 foreclosed houses. That's a 1.45% increase month over month and a whopping actually 14% increase year over year. And I would argue that's actually the thing that matters the most. How many houses are the banks taking and selling, right? That's up 14%. Year over year. Now, when we look at the total number of properties that are either 30 days past due but not in foreclosure, we're at 1.65 million. That's up 11,000. Historically, I know that looks like a big number because it is a big number. 1.6 million families is a lot of people. But again, historically, that's just not that high, surprisingly. Now, when we go to serious delinquencies, we're sitting at, again, relatively low at 471,000. Now, that group of people is the biggest at risk of losing their house because they're already 3 months behind. Now, the number of total properties that are in pre-sale inventory are 224,000 homes. Just to let you know, there are certain places on the web that you can go to access pre-foreclosure inventory if you want to get a jump start on finding a foreclosure deal. But I would caution you, a lot of times they're beat up. But the total number of properties in foreclosure or in default, y'all, 1.87 million. That is actually up 6,000. So month over month, that actually did get slightly worse. Moving on over to the top 5 states of non-current percentage, pretty much all the usual suspects except Pennsylvania, sitting there at number 4 at a default rate of 4.85%. Pretty high default rate. Mississippi sitting at number 1 at 7.4%. That's kind of whopping, but they did peak somehow 23% October of 2005, and Louisiana actually peaked at 30% default rate back in October of 2005. And again, I just wanted to point out, that's 2005. We didn't even start the foreclosure crisis until what, 2009-ish, would you say? Pretty crazy. Now, here's the bottom 5 states. Washington's number 1 spot, Colorado, Idaho, Oregon, and Montana's on the list as well. I always find this interesting. This is the bottom 5 states of monthly change in defaults. Surprisingly, Idaho is up there at a 15% change, followed by Utah, Arizona, Delaware, and Michigan. Very interesting. Overall, the foreclosure process and the loan modification process to keep people in their houses is working. And how couldn't it if the lenders are willing to forgive principal and give borrowers a much lower payment? Now, on average, when I go into the loan prevention data, most people are saving between 20 and 30% off of their mortgage payment. And then some people are also getting that plus some of their principal forgiven. So loan modifications, you guys, are really helping a tremendous amount of people stay in their properties. Now, a lot of people don't like loan modifications. I'm one person that thinks that maybe we should consider loan modification depending on the hardship. Another interesting fact is the average foreclosure takes over 3 years to complete. So in other words, so long as the banking system is okay and the banking sector is fine, they'll probably continue to push loan modifications. But I can also tell you guys this, the moment that those defaults start to pick up and the banking system collapses, I doubt highly that these lenders will be so forgiving when it comes to loan modification. Looking at just that, not really too much concern, although we understand that can spiral out of control as a result of things like unaffordability and the lack of being sustained, things like that, right? But really what I want to do is paint us an even bigger and broader picture so that we can really dig in to the health of the consumer. And let's start with credit card debt. It never ceases to amaze me. This is consumer credit card debt. Is basically, guys, in about 2 years and a few months, credit card debt has gone up by over $250 billion. We're sitting at $994 billion right now. And again, in about 2 years, We increased that by over $250 million. The debt spending right now, you guys, is out of control and it's getting worse. And credit card debt is literally the worst legal debt. I would say mob debt is the worst debt, but this is the worst debt you can possibly get in because the minimum payments don't pay this down. This is a trap. This is a scam. And there are more and more Americans drowning in debt every single day. And that's not all, you guys. This is the Fred Motor Vehicle Loans owned. Again, holy smokes. Ever since lockdown, this has been shooting up because of all of the money printing. The inflation is not transitory. The Federal Reserve printed the money and put it in our checking accounts. The inflation is here to stay. That's why we need more quantitative tightening. We need to stay in this environment. But we have $1.43 trillion in car loans right now. And some people's car loans, you guys, are $1,000 a month. The delinquency rate right now for subprime vehicles is where it was during the great financial collapse. Subprime auto loan market right now, you guys, is having an absolute meltdown, and that's followed by commercial. I'm not even going to go into commercial real estate, but auto loans right now melting down and causing companies to pull out of the auto industry entirely. And if that wasn't bad, look at the personal savings rate for Americans. This makes me so sad because I know there are so many people struggling right now. And I know some people are just going to struggle, but there's also an overwhelming amount of people that don't have to struggle, but are struggling because of the way they live their life, right? Buying too much crap, not saving enough. But look at the savings rate. It's only 4.6%. So households are only saving 4.6% of their income prior to COVID. Look at this. It was almost double. We were saying the 8 and 9%. Look at this, y'all. Super sad. So we have this huge money printing, huge money dump, and yet lowest savings rate almost in history. How depressing is this? Things are just so unaffordable and people are just such bad spenders. America can't save money anymore. And taking a quick look at evictions, and I only want to look at Las Vegas, you guys, look at the evictions in Las Vegas. 132%. Again, 132% above pre-COVID. So this is above the average. Absolutely shocking, you guys. And this is all over the place. 150% above the average, 189% above the average, 195% above the average, 110% above the average. You guys, the eviction crisis is spreading to almost every metro area, at least big metro area, major metro area around the nation. Consumers are suffering massively. And one of the reasons that is there's so many Americans living paycheck to paycheck. Absolute disaster, catastrophe. Look at this map here, guys. People in the South, on average, 60.5% of people, all people, living paycheck to paycheck, saving no money. Anything happens at all, they lose their job, they're dead in the water. That's scary. On the West Coast, 64% of people paycheck to paycheck. Crazy. Midwest, 61%. Northeast, 58.6% living paycheck to paycheck. Now look at the bankruptcy filings. Individual Chapter 13 filings are up 23%. It's important to watch Chapter 13 because basically Chapter 13 are homeowner bankruptcies. Chapter 7 bankruptcies is basically where you could just walk away from your debt. The 13 is you kind of freeze your debt, make payment plans, but you get to keep your house. So all in all, although those foreclosure numbers were actually pretty decent, when we take a bigger look at the health of the consumer and we look at the trajectory of the trends, we can see a much clearer picture here. And that picture is potential default crisis right around the corner. It's probably not going to start with mortgages, but it's certainly starting in subprime vehicles and spreading on over to other consumer debt sectors. Now, other than that, guys, I really hope you enjoyed this video. You enjoyed this report. If you can, one more time, like this video, share it as well. And if you're out there investing in real estate, you know I wish you luck and I hope you win.